Welcome to today's video, where we explore why teens have a unique edge in building wealth by starting with ETFs early. We'll connect the dots between compound interest, low-cost diversification, and smart safeguards like liquidity and legal requirements. Stay with me from start to finish, because we're going to build a practical, step-by-step plan any teen can follow, with quizzes to lock in your learning. Now let's move smoothly into our roadmap so you know exactly what we'll cover. Here's our roadmap. We'll start with a short disclaimer, then cover why starting early matters. Next, we'll define ETFs, set up a smart emergency fund, and outline the legal steps for teens. After that, we'll show a sample allocation for 1,000 units, walk through placing your first ETF order, and address risks and expectations. Finally, we'll test your knowledge with 2 quick quizzes and end with a concise recap. With that overview set, let's first establish our important disclaimer. This video is for education. It is not financial, legal, or tax advice. Markets involve risk, including loss of principal. Minors must follow local laws and typically need a parent or guardian for custodial accounts. Always maintain liquidity for emergencies before investing. Please conduct your own research, read official documents like prospectuses or fact sheets, and consult a qualified professional if needed. With the foundation set, let's transition to the math that makes starting young so powerful. Compounding is growth on growth. When you start in your teens, you give your money decades to multiply. For example, a lump sum of 1,000 units growing at 7% annually for 50 years becomes about 29,457 units, while the same 1,000 over 40 years becomes around 14,974 units. That 10-year head start can nearly double your final result. The key is to be consistent. Small, automated contributions often outperform sporadic large ones because they keep you invested through market cycles. Ultimately, time in the market generally matters more than trying to time the market. Now that we understand the power of time, let's flow into how to decide when you're actually ready to invest. This flowchart begins with a simple question: are you ready to invest? First, you check your emergency fund. If you don't have sufficient liquidity, aim for about 25% of savings, or roughly 3 months of essential expenses. You pause and build that cushion. Once your emergency fund exists, you verify whether you're legally eligible to open an account. If not, you set up a custodial account with a parent or guardian. From there, you open a brokerage account and purchase low-cost ETFs. Finally, you establish a loop for ongoing contributions and periodic rebalancing. Next, having mapped readiness, let's define exactly what ETFs are and why they're a strong starting point. An ETF is a fund that trades on an exchange like a stock, but it holds a diversified basket of securities. This structure provides an easy on-ramp to diversification, because with one purchase you can gain exposure to many companies or bonds across countries and sectors. Index ETFs are typically low cost, keeping more of your returns compounding over time. They're also liquid. You can trade them during market hours. Many ETFs pay dividends and allow you to reinvest automatically. Still, ETFs involve market risk and may experience tracking error. There can be currency and tax factors depending on your region. With the basics covered, let's compare ETFs to the traditional piggy bank. On the left, the piggy bank offers simplicity and instant access, but cash tends to lose purchasing power over time due to inflation and earns little to no return. It can be useful for very short-term goals or for very young children. On the right, ETFs give diversified market exposure with the potential for higher long-term growth. They do carry volatility and risk, but dividends and reinvested gains can accelerate compounding. In short, piggy banks are for ultra-short-term savings, whereas ETFs fit medium to long horizons. With that contrast clear, let's build the protective moat, your emergency fund. Start by listing your essential monthly expenses, such as food, transportation, phone, and school fees. Set a target for your emergency fund of at least 25% of your total savings, or around 3 months of those essential expenses. Keep this money in a high-yield savings or a conservative money market account. Automate contributions until you reach the target. And if you withdraw from this fund, replenish it as soon as possible. With your liquidity secured, let's translate this into a concrete example, using a 1,000-unit starting amount. This table shows a sample allocation for 1,000 units. We reserve 250 units, or 25%, in a high-yield savings account for emergencies. Then, we allocate 600 units, or 60%, to a broad global equity ETF for diversified growth. Finally, we put 150 units, or 15%, into a short-term, high-quality bond ETF to reduce volatility. Percentages can be adjusted to suit your risk tolerance and regional product availability.
Now that you've seen a concrete split, let's test your understanding with a quick quiz.
Question: before buying ETFs, what liquidity safeguard did we recommend in this video? Options: A. Borrow money to invest more. B. Maintain an emergency fund around 25% of savings, or approximately 3 months of essential expenses. C. Invest 100% immediately for maximum growth. D. Buy crypto instead of keeping cash.
You may pause the video now to think about the answer.
We will discuss the answer in the next section of the video. The correct answer is to maintain an emergency fund around 25% of savings, or approximately 3 months of essential expenses. This liquidity buffer reduces the chance you'll need to sell investments during a market downturn and helps you stay invested for the long term. With that safeguard confirmed, let's turn to the legal steps teens must follow. Legal eligibility is crucial. In many places, you must be at least 18 to open a brokerage account. If you are under 18, you often need a custodial account with a parent or guardian, such as a UGMA or UTMA in the United States. Know your customer and anti-money laundering requirements apply, so be prepared to provide identification and documentation. Look into any local tax-advantaged accounts that might be appropriate. For example, a junior ISA in the United Kingdom, or a Roth IRA in the United States if you have earned income. Parental involvement is typically mandatory for minors. With legal steps clarified, let's visualize a sample allocation as a pie to reinforce the concept. This pie chart illustrates the same starter portfolio visually. A quarter of the circle is the cash reserve, providing liquidity. The largest slice, at 60%, is the global equity ETF for broad growth potential. The remaining 15% is the bond ETF, helping stabilize returns. This visualization reinforces how liquidity and diversification can coexist. Next, let's walk through the practical process of placing your first ETF order.
Start by selecting a reputable, low-fee broker that supports minors via custodial accounts if necessary.
Link your bank account and complete identity verifications.
Research a diversified, low-cost ETF and read the fund's fact sheet, paying attention to fees, index tracked, and domicile. Locate the ETF by its ticker symbol, which varies by region. Choose your order type.
A market order typically fills quickly, while a limit order allows you to set a maximum price. After placing the trade, enable dividend reinvestment if the broker supports it, and set up small recurring contributions to dollar cost average. Finally, schedule rebalancing at a sensible interval.
To demystify what happens behind the scenes, let's look at a trade execution sequence.
This sequence diagram shows the life cycle of a trade. The teen submits a buy order to the broker. The broker routes the order to an exchange, where it is matched, often with a market maker providing liquidity. Once matched, the exchange confirms the execution back to the broker, who then confirms to the teen. The broker also coordinates settlement with the custodian, and after settlement, typically T+1 or T+2 depending on the market, the shares are credited to the teen's account. With execution demystified, let's cement a few rules of thumb using quick markdown notes and formulas. Here are fast rules of thumb. First, the liquidity rule. Maintain around 25% of savings, or about 3 months of essential expenses before investing. Second, the compound interest formula equals future value equals principal times 1 plus the rate raised to the number of periods. For example, 1,000 at 7% for 50 years is about 29,457. Third, the rule of 72 estimates doubling time by dividing 72 by the expected annual return.
At 7%, money doubles in a little over 10 years.
Finally, dollar cost averaging works best when automated, which reduces emotional decisions. With those principles in mind, let's challenge your understanding with a second quick quiz. Question: which feature primarily gives ETFs their diversification benefit? Options: A. They track baskets of many securities. B. They guarantee returns. C. They are insured against losses. D. They trade only once per day. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that ETFs track baskets of many securities. This structure spreads risk across multiple holdings, sectors, and regions rather than concentrating everything in a single stock. With diversification clarified, let's discuss risks, fees, and setting realistic expectations. Markets are volatile, and drawdowns are inevitable. Your emergency fund reduces the pressure to sell at the worst times, allowing you to stay invested. Expense ratios matter. Lower fees generally support better long-term outcomes. Tracking error is normal, because ETFs seek to replicate an index rather than outperform it, and the copy is never perfect. If you invest across borders, be mindful of currency fluctuations and tax rules. Take a long view in decades, not days. Build a behavioral edge by automating contributions, avoiding panic decisions, and rebalancing on a regular schedule.
With expectations set, let's wrap up with the key takeaways. The key takeaways are: start early because time is your biggest advantage. Keep a cash reserve of roughly 25% before investing. Use low-cost diversified ETFs as your core holdings. Follow the legal steps appropriate to your age and region. Automate contributions and dividend reinvestment, and stay the course through volatility. With the highlights in place, let's summarize the journey and your next steps.
In summary, starting early harnesses compounding to your advantage. You now have a framework that prioritizes an emergency fund before investing, an understanding of what ETFs are and how they diversify your exposure, and a sample allocation for 1,000 units. You also learn the practical steps to place your first order and the risks to watch. As a final step, let's close with a quick thank you and a call to action.
Thank you for watching. If you found this useful, please like the video, share it with a friend who needs a head start, and subscribe for more practical guides. I'd love to hear your questions and experiences in the comments. Tell me which ETF you're considering and how you're setting up your emergency fund. See you in the next one.